Hey there, I'm Bobby Jones, a retired nurse anesthetist turned alternative investor. Now, there have been a lot of changes in multifamily investing over the last 6 months, but the one I'm asked about the most is rising interest rates. I'd love to take a moment to break it down for you, which I can do in four different parts: lenders, buyers, sellers, and investors. Lenders have already begun to act to the Fed's shift in monetary policy by raising their interest rates, as you well know by now. Whether that will continue or not, well, that's incredibly difficult to forecast. And the forecasts are often wrong more than they're not. The current interest rate hikes generally means that the cost of borrowing for both fixed and variable rate loans has increased significantly. Not only that, but lenders are actually decreasing the amount of leverage that they are willing to extend to buyers. A few months ago, you could get a bridge loan with 75 to 80% financing for a multifamily property, even those properties that are 40 to 60 years old. They're not old, though. They're vintage, right? Now, those same lenders are only offering 65 to 70% leverage. That's a significant difference. And on top of that, the interest rate caps that are required by bridge lenders are up 10x year over year. That means if you paid $30,000 for a rate cap last year, you'll pay well over $300,000 today for the same thing. That's pretty crazy, right? The combination of these three factors really has an impact on the underwriting from buyers. With those higher interest rate expenses, lower loan proceeds, and higher interest rate cap costs, buyers are seeing underwriting that just doesn't work out for them. They are hit in the face when they think that they have enough capital per their business plan, only to find out that they're actually not going to be able to get the loan that they need. Imagine having $1 million in the bank and ready to go for a particular deal with your investors, only to find out that no, you need to go back and raise another $500 to $600,000. That's hard to do, particularly for newer companies. More equity required generally translates into lower returns, which investors don't want to go for. Buyers can go back to the seller to ask for a price reduction, and some will walk away from hard money loans in favor of deals where sellers have already lowered their prices. Either way, the increased cost of doing business and the increased capital demands will reduce the number of buyers in multifamily overall. The buyers who do remain active are likely experts who are well capitalized in their ventures. Now, let's talk about the sellers. There are two types here: deliberate and unintentional. Deliberate sellers are often experienced operators with strong balance sheets. Most deliberate sellers will probably hold on to their assets during this time of uncertainty. And that's because it's their choice to wait out the storm. And they can do that because they've not taken on more than they can handle. If they do want to sell, they can always entertain off market offers and then hand pick those stronger buyers to get top dollar for their assets. Unintentional sellers, on the other hand, are forced into making a move. They are over leveraged, undercapitalized, or both. And that, or perhaps they don't run the property very well. These are generally inexperienced, overly aggressive syndicators who happen to just take as much money from the bank as they could in order to just get a deal under contract. Or they may be mom and pop operators who just aren't the most business savvy. Either way, unintentional sellers see big losses on the horizon, so they try to get out now while they still can without losing their shirts. And this creates buying opportunities for those experts that we spoke of earlier. So, how do rising interest rates ultimately affect apartment investors? Well, it requires a mindset shift in the types of assets that you're looking for. We spoke about leverage earlier, and that's an important consideration pretty much anytime you're looking at a deal. Projects with lower leverage and a strong cash reserve are best positioned for periods of uncertainty. But in the past, B and C class assets were really the toast of the town. These are largely rented by the working class. And even just a couple of years ago, they were primed for great returns and resiliency during recession. And many of them still are. So don't get me wrong here. You can still find these properties that have that value in different pockets of the country. But we've all seen the rents increase across the country at incredible rates, and middle class wages have simply not kept up at the same pace. Eventually, the middle class is like an orange where the juice has already been squeezed. There may only be a few drops left. So at this time, I am more of a proponent of A and B plus class assets in general. Why is that? Well, because the renters here have much higher incomes and they can comfortably afford the rent hikes that operators typically depend on to produce their returns. But it's not enough to just look at the asset. You have to look at the market surrounding the property as well. Markets that are booming with population and job growth are likely to be better bets as they can support that rent growth due to supply and demand factors. You can still find fantastic returns, but you should be prepared to be realistic and patient. There are things that will happen that are unpredictable, but seeking out experienced operators with good track records and strong asset management skills will go a long way to not only protecting your investment, but growing your wealth for the long term. Now, luckily for you, this is what I strive to offer you at On Call Capital. I work with experienced operators in great markets to provide you with those opportunities to generate passive income and grow your wealth. If you're interested in starting your own alternative investment journey, reach out to me through the links below. That's going to do it for this video. If you liked what you heard, give me a thumbs up and share this with your family and friends. Until next time, be safe and take care of each other out there.